Mr. Chairman, I would hope that we would have a separate hearing devoted exclusively to the horrendous revelations at the FDIC. What we have here is this Hobson's choice of using our time to focus on how 6,600 employees of the FDIC have been treated and how we're going to dramatically affect the entire economy. And I'm going to focus on the latter, but I hope we have a hearing where we can focus on the former.
I'm happy to accommodate the ranking member.
And my concern, especially for Mr. Barr, is that this overall approach, first, it's being sold as if it's conforming with a European or international standard, but actually we're going to have much higher standards than Europe. That means less lending. But then we're going to have these higher standards, but then we're going to have lower standards than we should have for money going to Wall Street. For example, we ignore the interest rate risk on long-term bonds that are in the, quote, hold-to-maturity account. I want to commend you for at least dealing with the available-for-sale account, but Wall Street investments, as we learned from Silicon Valley Bank, it is the interest rate risk that's the big risk, and that risk is undercounted. What we also undercount is we have only a 65% rate for loans to publicly traded companies, where an equivalent company that isn't publicly traded, the 100% rate. There are many ways to raise money on Wall Street, but that local pizzeria can only raise money from the bank, and anything that makes that loan less likely to happen concerns me. But I also want to focus on the discount. There are rumors or reports that you're going to change the rules for discount window. I would hope that you'd make that window more available to small and medium-sized banks and make the technological changes necessary. But the proposal is that the amount of capital that would have to be pledged would relate not just to the amount being borrowed, but whatever the bank had in uninsured deposits. And that you'd end up with the absurd circumstance that if a bank wanted to borrow $1 million, but happened to have $1 billion in uninsured deposits, it would have to pledge $400 million in capital to make a $1 million loan, to borrow $1 million from the. Can you assure me that the amount of capital that you have to pledge to borrow from the discount window will relate to the amount you're borrowing from the discount window and not based on the total uninsured deposits of the bank?
Thank you, Representative Sherman. You've touched on quite a number of topics. I'll say on the credit side, first of all, with respect to capital.
If you could just focus on the question I asked, I have limited time.
The question related to discount window preparedness, we're working through the substance of that now. We are looking at a range of measures to make sure that banks are ready to use the discount window, and one of those requirements.
Can you assure me that the amount of capital you pledge will relate to the amount you borrow from the discount window, and that this will not relate to just the general balance sheet of the bank?
We are looking at
It's a yes or no question, sir.
We are looking at a range of ways to think about.
Okay, so that's not an assurance, and the absurd example I just gave you could, under your answer, be the new rule.
I'm not sure I fully understood the nature of the example, but we are looking at a range of ways of making sure that banks have enough discount window preparedness.
We would make it possible for mid-sized banks to accommodate charities and businesses that have to have accounts of over $250,000 for operations. I'm concerned about the effect that these new rules are going to have on our capital markets, but I do want to focus on that 65% rule. You apply it to publicly traded borrowers, but what about what about mutual funds, pension plans like CalPERS? Is there any reason they wouldn't get the 65% rate?
We are looking at comments on all these issues with respect to the proposal. We received very helpful comments on credit risk, including the issues you raised with respect to pension funds and mutual funds.
Can you assure me that you will treat clean energy tax credits just as we currently treat low-income housing tax credits?
We got very helpful comments on the tax credit provision, pointing out, for example, that the return to the investor is not based on the equity investment, but really on the tax credit return. So that is a useful piece of information for us as we're thinking about
I would
this
hope
rates.
that you would design these rules so that banks will lend money to small businesses rather than simply put their money in highly risky, long-term bonds sold on Wall Street, and I yield back.